China did not announce a ban on silver. China tightened a gate. And in commodity markets, gates matter more than headlines, because gates decide who can move the metal when everyone else is rushing for the same door. If you only watch the price chart, this looks like nothing. A dry notice, a set of application requirements, a list of criteria that decides which enterprises are allowed to export silver through a state trading channel for the coming years. It reads like bureaucracy. It sounds like compliance. It is the kind of document that gets ignored right up until the moment the market starts acting like the metal itself has vanished. But silver does not become dangerous because the world runs out of silver. Silver becomes dangerous when the world runs out of deliverable silver in the right place, in the right form, at the right time, under the right permissions. That is the real story. Not doom, not myth, not a cinematic villain. Friction. Friction is the invisible tax on supply chains. It is the extra signature, the narrower approval pathway, the smaller club of authorized exporters, the compliance requirement that turns a normal shipment into a delayed shipment. Friction does not trend on its own. It does not go viral, but friction is what makes premiums rise, makes dislocations persist, makes buyers stock up, and makes markets behave as if they have less metal than they actually do. So the question is not whether silver exists. The question is whether silver can move. And here is the claim you came here for. Stated plainly, China has formalized stricter gatekeeping over who is allowed to export silver through its state trading framework for the coming window. The gate is a qualification filter that concentrates export access into approved hands. That can change bargaining power and delivery timing at the margin. And in tight markets, marginal changes decide price. If you are watching this, hoping for a simple yes or no answer, will this make silver explode? You are going to get something better than a yes or no. You are going to get a map, because the honest answer is conditional. If the gate becomes real friction in practice, the market will pay up for immediacy. If the gate stays mostly administrative, the impact will be smaller and the market will shrug. Either way, you do not survive silver by guessing. You survive silver by watching what the plumbing is doing. This is education, not personal financial advice. I do not know your balance sheet, your time horizon, or your exposure. What I can do is explain the mechanism so you are not trapped inside someone else's panic narrative. Now picture a port at night, rain on steel, container stacks like dark buildings, floodlights that make everything look colder than it is. A forklift moves a pallet that looks ordinary to anyone who has never had to guarantee a production line stays fed. But that pallet is not ordinary. It is a promise. It is a promise that a specific input will arrive on a specific schedule. And the promise only holds if the paperwork holds. If the paperwork fails, the metal does not matter. You cannot build with it. You cannot deliver it. You cannot count it. You cannot settle a contract on hope. That is why paperwork is power. Most people imagine commodity power as mines and ships. In the modern world, commodity power is also permissions, licenses, qualifications, compliance, the right to move material across borders through official channels. China is not the entire silver market, but China matters because China sits inside an enormous share of global manufacturing and processing. Silver is not only an investment story. Silver is also a material embedded inside electronics, inside industrial components, inside energy infrastructure. Those supply chains care about timing and reliability as much as they care about price. And timing is where gates do their work. When a gate is wide, the market is resilient. Buyers have choices. Exporters compete. Delays get arbitraged away. A hiccup in one lane is offset by capacity in another. When a gate is narrow, the market becomes sensitive. Optionality shrinks. If the authorized list is small or concentrated, buyers cannot easily switch counterparties. If approvals are slower, deliveries slip. If enforcement is strict, informal detours carry risk. Under stress, the value of being inside the gate rises, and the cost of being outside it rises even faster. That is the first reason this matters, even before you talk about ounces. Now, let us build a clean mental model, because if you cannot explain this to a smart teenager, you do not really understand it yourself. There are two overlapping silver worlds. There is physical silver, which is metal in real places. Bars, coins, industrial feedstock, intermediate products, inventory in warehouses, inventory in transit. Physical silver moves through logistics, fabrication capacity, insurance, customs, and counterparty trust. When physical tightens, it shows up in the price of a premiums rise, product availability narrows, delivery time stretch, terms get stricter. Then there is paper silver, which is exposure, futures, and options, funds that trade like shares. Institutional agreements that move with the price. Paper silver moves through collateral, liquidity, and and volatility. The paper market can move the headline price quickly, but it cannot fabricate a single ounce of metal. And when paper gets crowded and volatility rises, paper can amplify moves in both directions because leverage is a fragile form of confidence. These worlds are connected, but they do not move at the same speed. Physical can tighten quietly while paper still trades like everything is normal. That is when a market can snap, because the headline price is catching up to something that was already happening in the background. Paper can also run ahead of physical on narrative and momentum. That is when a market can overshoot and then punish late entrants, even if the long-term story is real. This is why your job is not to fall in love with one story. Your job is to know which world is leading and whether the other world is confirming. Now, what exactly is a state trading qualification filter in plain language? It means export is permitted, but only through authorized enterprises that meet specific criteria. It is a controlled channel, not a dramatic prohibition. A controlled channel. A controlled channel changes behavior because it changes the balance of power. If you have many competing exporters, the buyer has leverage. The buyer can shop. The buyer can walk away. Prices are disciplined by competition. If the exporter list is smaller, or if the criteria raise the barrier to entry, the exporter has more leverage. The exporter can prioritize, negotiate harder, and capture a higher premium for certainty. In a calm market, this leverage is limited. In a stressed market, it becomes decisive. Now add one more layer. The gate itself creates uncertainty, even if it does not reduce volume. When a market knows that export rights are filtered through approvals, it starts asking questions it did not have to ask before. Not dramatic questions, practical questions. Who is still qualified? Who might lose qualification? How fast are approvals renewed? What happens if a shipment is challenged? What happens if compliance is questioned? What happens if enforcement becomes stricter? In commodities, questions like that change behavior. Buyers add buffer. Sellers demand better terms. Intermediaries widen spreads. Everyone becomes a little less willing to take risk on thin margins. That reduction in willingness is the beginning of friction. And friction is how scarcity is felt. This is where people make the wrong assumption. They hear gatekeeping and they immediately jump to volumes as if the only way a policy matters is if it slashes export ton. That is not how tight markets work. In a tight market, what matters is not only how much metal exists, but how quickly metal can be mobilized to meet urgent demand. The difference between metal now and metal later is a premium. If the gate slows mobilization, even slightly, the premium can rise. If the gate concentrates decision-making into fewer hands, the premium can rise. If the gate increases uncertainty, buyers can preemptively stock up, and the premium can rise for that reason alone. So you do not watch for apocalypse. You watch for the price of immediacy creeping upward and refusing to come back down. Now I'll take a step into the real economy, because this is where the story stops being abstract. Imagine a manufacturer whose product requires silver for performance. The silver content may be small relative to the final price, but it is not optional. The process depends on it. The line cannot simply stop because a supplier is late. The worst case for that manufacturer is not paying more. The worst case is uncertainty. When uncertainty rises, the manufacturer does not post on social media. The manufacturer calls suppliers, renegotiates terms, and increases inventory buffer. Buffer is expensive, but downtime is worse. When enough manufacturers do this at once, demand pulls forward. Pull forward demand tightens the near-term market. Tight near-term markets are where dislocations begin. Now imagine the exporter who holds the credential. They see the urgency. They see the pull forward demand. They see that the gate gives them leverage. Their rational response is to protect their position and capture value. They may quote higher. They may demand stronger payment terms. They may prioritize certain clients. They may slow sales if they believe better prices are coming. This is not evil. This is how markets respond when the balance of power shifts. Now imagine the intermediary who tries to keep prices aligned across regions by moving metal. Their job is to exploit small differences and close them. But that job depends on smooth flow. If the gate makes flow slower, riskier, or more dependent on a small set of counterparties, the intermediary needs a bigger cushion. Bigger cushion means wider spreads. Wider spreads mean dislocations persist longer. Persistent dislocations become a signal that something in the plumbing is tightening. And once the signal becomes visible, the paper market gets involved, because the paper market is always looking for a story it can trade, and a story tied to supply chain friction is one of the most powerful stories there is. This is where silver gets volatile. Silver is a hybrid metal. It can behave like a monetary asset and an industrial input. That dual identity is what makes it explode on certain narratives and collapse on certain shifts in macro conditions. When you mix supply chain friction with investor attention in a market that can be thin under stress, you get convulsions, not smooth trends. That is why you should not ask whether the story is bullish or bearish. You should ask whether the story is because destabilizing stories create opportunity and risk at the same time. Now, the honest analysis always includes a counter case. The strongest opposing view stated clearly. The counter case is that this could be largely administrative. Many exporters may already qualify. The authorized list may remain broad enough that competition remains healthy. the approval process may run smoothly. The market may adapt quickly. Alternative sources and routes may compensate. Inventories may buffer. In that case, you might see a brief premium flare and then normalization. The paperwork is real, but the impact is small. That is a plausible outcome, and you do not defeat it with enthusiasm. You defeat it with evidence. So here is the framework you use to stay grounded. You do not watch a commodity only through the spot price. You watch the cost of immediacy is deliverable now, not later. Immediacy is inventory you can access, not inventory that exists somewhere far away under constraints. Immediacy is a shipment that clears without drama. Immediacy is a contract you can fulfill today. When immediacy becomes expensive and stays expensive, the market is tight. When immediacy becomes cheap again, the market is loose. The spot price can be dragged by narrative and leverage. The price of immediacy is where the real system reveals itself. So what does expensive immediacy look like in silver? It looks like persistent premiums, not a brief spike. It looks like regional dislocations that do not close quickly. It looks like tighter terms, longer lead times, and allocation language creeping into conversations. Allocation is a quiet word that becomes a siren. It means you can buy, but only a limited amount, and only on the seller's schedule. If this story is real, that is where it will show up first. Not on a chart, in the terms of trade. Now, because this is silver, you also need to understand how the paper market reacts when physical stress persists. When physical stress persists, paper tends to overreact. The price runs, the narrative spreads, momentum attracts leverage. Leverage magnifies the move. Volatility rises, risk managers tighten collateral. Then the market can drop sharply, flushing weak hands, even if the underlying physical tightness is still present. This is the silver pattern. It seduces, then punishes, then rebuilds if the foundation is real. So the smart approach is not to confuse a pullback with a thesis change. In silver, pullbacks are the toll you pay for volatility. The thesis changes when the fingerprints disappear, when premiums normalize, when dislocations close, when allocation language fades, when the cost of immediacy falls back to normal. Now zoom out one more step, because there is a strategic layer that matters here without needing conspiracy. A qualification system creates optionality for the state. It allows tightening or loosening without a loud political event. Loud bans create backlash. Quiet credential changes look like management. Management can be adjusted. That is capability, not a claim of intent. Markets price capability, especially when geopolitical and supply chain tensions are already elevated. So what do you watch next? If you want to know whether this is turning from paperwork into pressure, you watch whether the gate tightens in practice. That means you watch for signs that the authorized club is narrowing, that approvals are becoming more restrictive, that enforcement is becoming more serious, that exporters report difficulty, that buyers report delays. You watch physical confirmation, persistent premiums, persistent dislocations, persistent tightness in the forms of silver that matter to industry. You watch paper stress, rising volatility that aligns with physical signals, not just hype. These are diagnostics, not predictions. They are the difference between being early and being emotional. And once you understand that, the story becomes simple. China did not need to shout. It only needed to formalize a gate and preserve the option to tighten it. In commodities, the quiet moves change the background physics of the market. Background physics is what turns normal demand into urgency. Urgency becomes premiums. Premiums become dislocations. Dislocations become chart moves that look sudden to anyone who is not watching the plumbing. Silver can ignore paperwork until the day it cannot. When that day comes, it does not move gently. It moves like a door slamming in a crowded hallway. And that is why a gate matters even before it shows up in the headline price, because the market does not wait for certainty. It reacts to the probability of friction. The moment export access becomes something that must be qualified and renewed. Every participant begins pricing the risk that a routine flow could become a constrained flow at the worst possible time. Not because anyone has to announce a crack, because the system has been built to allow tightening without drama. The lever exists, the option exists, and option value is real in commodities. Now let us go deeper into what this kind of gate is really designed to do. A loud ban is blunt and expensive. It triggers backlash. It forces everyone to react at once. It creates a clear villain and a clear headline. It is hard to reverse without losing face. That is why bans are rare and politically costly. A qualification filter is quieter. It can be explained as management. It can be explained as standards. It can be explained as compliance. It can be tightened or loosened through criteria language, through enforcement intensity, through the pace of approvals, through who is added and who is not. And because it looks administrative, the market often underestimates it until the moment it matters. This is the kind of system that does not need to be weaponized to be powerful. It is powerful simply because it shapes who has access and how fast access can be scaled when demand surges. So now we ask the most important question of the entire episode. The question that decides whether this story becomes a real market event or remains background noise. Does it create persistent friction in practice? Not in theory, not in intention, in practice. Because practice is where markets live. In practice, the market will tell you what is happening through behavior. It will tell you whether buyers are calmly sourcing or urgently securing. It will tell you whether sellers are competing for volume or rationing for margin. It will tell you whether intermediaries are easily closing dislocations or struggling to do so. It will tell you whether the cost of immediacy is rising and refusing to fall back. So we build a clean way to read the behavior, start with the physical side, because physical is where scarcity is felt before it is believed. If this gate is becoming real friction, you will hear the same language repeating across the supply chain, quietly, in different forms. You will hear longer lead times described as normal. You will hear allocation described as reasonable. You will hear minimum order sizes rising. You will hear terms tightening, not just price, but payment terms, delivery terms, penalties, and guarantees. You will hear buyers talking less about getting a better deal and more about securing continuity. And you will see premiums behaving in a specific way. A healthy, loose, physical market can spike premiums briefly and then normalize, because supply responds and arbitrage closes gaps. A tightening physical market creates premiums that stick. The premium becomes a rent you must pay to get metal now. And when that rent becomes sticky, it signals that the system is not clearing smoothly. Now move to regional dislocations. In a smooth world, if one region pays up, material flows toward that region and the difference closes. When a gate adds friction, those flows slow. The difference persists. Persistent dislocation is not just a price quirk. It is a sign that something is preventing the system from doing what it normally does. Now, shift to the paper side, because paper is where speed turns into violence. Paper markets react to stories, yes, but paper markets also react to stress. When physical stress persists, paper markets tend to amplify, because a tightening physical market attracts speculative attention, and speculative attention attracts leverage. Leverage turns a rational story into an unstable story, and when a story becomes unstable, volatility rises. When volatility rises, the system tightens collateral. When collateral tightens, weak hands are forced to sell. When forced selling hits a market like silver, the drop can look like a collapse, even if the underlying physical story is still intact. So the most common mistake people make is this. They see a violent pullback and assume the story was false. Sometimes it was false. But sometimes the pullback is simply the leverage purge that makes room for the story to continue in a healthier way. That is why you do not judge the story by a single candle. You judge it by whether the physical fingerprints remain after the purge. If premiums remain stubborn, if dislocations return quickly, if availability remains tight, if the cost of immediacy remains elevated, then the story has structure, not just hype. Now let us talk about the conditions that would make this gate matter more, because gates matter most when the hallway is already crowded. If industrial demand is firm and steady, it does not take much friction to create urgency. If inventories across the chain are lean, it does not take much delay to create a bidding war. If logistics are strained, it does not take much paperwork to create a bottleneck. If investors are already watching silver, it does not take much tightening language to trigger flows. Under those conditions, small friction becomes meaningful friction, and meaningful friction becomes a premium, and premiums have a way of becoming headlines. Now here is the part that most viewers do not think about, but it is the heart of the matter. A silver squeeze is not only about silver, it is about timing of obligations, factories have schedules, contracts have delivery windows, products ship on deadlines. If silver is late, the cost is not simply a higher invoice. The cost is production disruption. The cost is penalties. The cost is reputational damage. The cost is missing a market window. So in a tight environment, buyers will pay far more to avoid delay than they will pay to save a small percentage on price. This is why the price of immediacy can rise dramatically, even if the total metal exists somewhere in the world, because what exists is not always what is available. Availability is a function of permission, logistics, and willingness to sell. And a gate can affect all three. Now let us bring this down to the human level, because this is where the story becomes emotionally real without becoming hysterical. Imagine you are a procurement manager. Your job is to keep a line running. Your job is to make sure the part arrives. You are not trying to win a debate about global macro. You are trying to avoid a crisis that ends your quarter. So when you see uncertainty in export permissions, you behave like a professional. You secure, you buffer, you diversify suppliers. You accept higher prices if it buys reliability. Now imagine you are a supplier with the right credentials. Your job is to manage your own risk and capture fair value. If you see buyers pulling demand forward, you do not rush to dump inventory. You quote higher because the market is telling you immediacy is valuable. You tighten terms because the market is telling you uncertainty has risen. You prioritize clients because you cannot serve everyone equally when demand surges. None of this requires a grand plan. It requires only incentives. Now imagine you are an intermediary. Your job is to move material where it is most valuable and keep spreads tight. When friction rises, your job gets harder. You need more cushion. You need more margin. You need more time. And that means dislocations persist longer. Persistent dislocations are where stories are born. Now imagine you are a paper trader. You see the story, you see the dislocations, you see the narrative potential. You buy, momentum builds. More people buy. Some buy with leverage. The move becomes fast. And then the system does what it always does in fast moves. It tightens collateral, it shakes the tree, it forces weak hands out, and the people who do not understand the difference between leverage, purge, and thesis collapse sell at the worst time. This is why silver is not just an analysis challenge. It is a psychology challenge. It rewards patience and punishes urgency. Now we go back to the counter case, because it deserves a deeper treatment. The counter case is not only that the gate is administrative. The counter case is also that markets adapt, supply chains reroute, alternative sources increase share, contracts shift, inventories are rebuilt. Over time, the system can absorb friction. That is true. But here's the critical phrase. Over time, the market does not trade the long run in a straight line. It trades the transition. And the transition is where premiums and volatility are born. So even if the world can adapt, the adaptation process can still produce the kind of tightness that matters for price and for behavior. This is why the right approach is not to declare that the gate changes everything forever or changes nothing at all. The right approach is to treat it as a background tightening of optionality that can matter a lot during certain stress windows. Now let us build the simplest decision framework possible for the viewer, because this is where you become harder to manipulate. When you see a story like this, you ask 3 questions. Is the gate creating friction in practice? Is physical confirming through premiums, availability, and persistent dislocations? Is paper stress aligning with physical through volatility and the cost of holding exposure? If the answers align, the story is real enough to matter. If the answers do not align, the story is context, not a trigger. Now, there is a deeper layer to this that explains why the market often misprices these moves. Markets are trained to respond to big, loud events. They are not trained to respond to quiet structural changes. Quiet structural changes are mispriced until they collide with a stress event. That collision is the moment when everyone suddenly acts like they always knew it mattered. This is why you will often see a delayed reaction. The document is published, the market shrugs. Then a few weeks later, a dislocation appears. A premium spikes. A delivery problem is reported, a rumor spreads, and the price runs. Everyone points to the latest headline, but the real cause was the background physics changing. Now let us talk about what this means for silver as an investment narrative, because a lot of viewers are not just watching for curiosity. They are watching because they have skin in the game. If your thesis is that silver is gaining a strategic premium as industrial demand remains important and supply chains become more managed, this kind of gate supports that thesis over the long run. But silver does not reward blind conviction. It punishes fragility. If you are over-leveraged, the market does not care that your thesis is correct. You will still be forced out in a volatility purge. If your time horizon is short and your plan is unclear, the market does not care that you have the right story. You will still sell at the wrong time when the move turns violent. So the practical lesson is not to worship the gate. The lesson is to respect what it does to the shape of risk. It increases the chance of sudden tightness episodes. It increases the chance of persistent premiums in certain windows. It increases the chance of dislocations that do not close as quickly as people expect. It increases the chance that silver behaves less like a clean macro trade and more like a stress asset with supply chain teeth. Now, because the viewer deserves a clear takeaway, we finish with a final synthesis that ties everything together without hype. China did not need to remove silver from the world to matter. It only needed to formalize the channel and concentrate who can use it. That changes up. Optionality is the invisible cushion that makes markets resilient. When optionality shrinks, the system becomes more sensitive to shocks. And when the system becomes sensitive, the price of immediacy rises, premiums become sticky, dislocations persist, and the paper market eventually reacts with speed. This is why a boring document can lead to a dramatic chart. Not because the document is magic, because the document changes behavior, and behavior changes flows, and flows change pricing, especially in a market as emotionally charged and structurally volatile as silver. So if you want to stay ahead of the crowd, do not chase the loudest headline. Watch the quiet signals. Watch whether immediacy is becoming expensive and staying expensive. Watch whether dislocations are closing smoothly or refusing to close. Watch whether buyers are acting like they trust the future or fear the future. That is how you know whether the gate is simply paperwork or the beginning of a pressure point. And if you remember nothing else, remember this. Silver does not move because you believe in it. It moves because the system can or cannot deliver it. When the system tightens, the chart follows. Late, then fast. And the only way to survive the fast is to understand the tight